Welcome back to Portfolio, everyone. And today we have to go over NIO, Tesla's rival. This is the Chinese electric vehicle company that has been growing rapidly over the past couple of months. Their shares have been on an insane run-up over the past year, where they were up over 360%, and you can see here a rapid surge over the past couple of months. So NIO is Tesla's rival. They operate within China right now, and they have plans to expand across the world. And this is a company that also produces very sleek and modern electric vehicles. And they have new news coming out on the market. So today, we're going to do a full analysis on NIO, go over their most recent news headlines to determine if we like the company where it is today, take a look at some future expectations for the company moving forward, and actually take a look at what analysts are saying on the stock right now to determine if we like it as a buy, or what analysts and professionals are saying if it's a buy or hold at its current state. So NIO has been in the headlines a lot, making a bunch of news saying they're coming out with new models, new subscription-based battery packages. They're planning on expanding across the United States and throughout Europe. And this is a company that has also been ramping up deliveries each and every quarter. So we're going to go over some key headlines, talk about whether or not we think this stock price is going to surge in the next coming months, and determine if we like this company right now and if they can be a real rival to Tesla sometime in the future. So thank you for tuning in, everyone. I am the Gen Z investor, and as you know, every single day on this channel, we talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So please like and subscribe, and we're going to get right into all the big news headlines to talk about with NIO. So the first big news headline is that NIO just announced this new subscription-based battery swap technology for their electric vehicles. So essentially, it allows electric vehicle drivers to swap their batteries in 5 minutes and then continue driving on down the road. So a big complaint with electric vehicles is the time it takes to charge at something like a supercharger when you're going on a road trip. So this is a way to kind of speed up that process and to mimic the same experience as if you were filling up your traditional car at a gas station. So NIO, the electric car manufacturer within China, announced their new plan, which is a battery swapping plan that makes the price of the electric vehicle $10,000 cheaper because they can actually sell it without the battery. So battery is one of the most expensive parts of the vehicle in an EV car. And of course, this gives them the plan where you can sign up for the subscription plan, have a couple battery swaps per month, and you don't actually need to buy the car battery up front. So to make this plan, realistic within the United States, they do need to expand their infrastructure. The electric vehicle market right now still isn't there where it needs to be, and I'm sure over the next coming years it will continue to grow. But in China, they're doing a little bit of a good job continuing to grow that market and actually having these stations set up across the country. So if we take a look, as the ranges for these EV vehicles continue to grow, the infrastructure for these battery swap stations will also need to grow as well. So this company, NIO, just unveiled this new plan to have a battery as a service subscription, where you can buy a car with the battery not included in the price, which will reduce the price of the car by around $10,000. So what this is when your car needs a new battery or it needs a new charge, the subscription-based model allows you to pull up to one of these stations, drive your car in, it will swap you out with another full battery, and now you can continue on driving in only a matter of minutes. So this service has just been going through China right now. It hasn't really been adapted across the world just yet, but NIO is a company that is working towards growing that type of service, and this could lead to some huge innovations for some American electric vehicle companies as well. And I'm sure Tesla one day in the future will continue and kind of match or surpass what NIO is doing today. So very interesting program. This was a new headline from NIO to see. I want kind of talk about to see if consumers actually rather have this plan where instead of buying the battery with your vehicle, you just pay this per month subscription, which ranges in price from around $142 to see if this is a better option for consumers over the long term. The other big news line for NIO is that they actually announced that they are planning to go global. So we already knew from previous reports that they plan to expand outside the country very soon. But this actually just came out last week. The NIO founder and chairman, William Li, told reporters that the Chinese electric vehicle company has plans to venture into different markets, and he's actually planning on starting that on the second half of 2021. And the first step for that plan is actually to go into Europe. He didn't specifically say which countries within Europe, but that is his first plan. And then over a few years after that, he plans on expanding, of course, towards North America and other areas within the world. So this company was on the brink of bankruptcy not too long ago. They got some funding from the Chinese government and some other investors. Now they're continuing to roll. They have increased deliveries, and now they have plans for expansion outside of their home country. Another big headline to see, because before we always had the rumor that they were planning to expand, but now we know for sure that they have announced that they have direct plans within 12 months from now to start operating and start selling vehicles in countries outside of China. The last report we have to take a look at was from their Q2 report, which talked about how many deliveries of their vehicles this company has been doing. And of course, they've seen massive delivery growth. Q2 2020 was their best quarter for deliveries yet, and they actually delivered over 10,000 vehicles in the 3 months ending June 2020. And of course, they didn't provide any guidance moving forward. They are expecting to deliver future growth in their vehicles over the next coming months, but of course, they didn't give a specific number. If we take a look, they actually delivered 3,740 vehicles in June alone, which was their best month ever, and their total deliveries as a company so far in their two main product lines are over 46,000 vehicles. So this is a company that continues to grow. They have these new service could make the car more attractive to more individuals. They're planning on expanding outside of their native country, and they have been growing their deliveries and surpassing their delivery expectations over the past couple months. If we take a look at their latest earnings report, this is what their business outlook is moving forward for the third quarter of 2020, the quarter we're actually going through right now. They're expecting deliveries to be between 11,000 and 11,500 vehicles, so they are showing an increase of around 130% from the same quarter in 2019, and an increase of around 7 to 10% from that previous quarter where we just saw they delivered around 10,300 vehicles. So they are showing that they have an estimated growth in vehicles over the next quarter, and they believe that they will continue to deliver a higher number over the next 3 months. And they also expect total revenue to increase by 120% compared to the same quarter last year. And they actually expect revenue to grow by between 8.8 and 13.3% from the second quarter of 2020, which already was their best quarter ever. So Q3, they're expecting to be a new all-time high in both revenue and deliveries for this company. If we take a look at what analysts are expecting. So of course, we're going to take a look at their financial statements in a little bit. But we saw what NIO has been doing, some of their big news headlines. They're offering this new battery swap service. They're expanding into different markets across the world, and they have some future outlook where they believe they can continue to grow deliveries each and every quarter. If we take a look at what analysts are expecting, you can see here, this current line right here shows where the company is today. They are not profitable yet, but over the next 2 to 3 years, analysts expect this company to continue to grow revenue year over year and actually become very close to profitable within 3 years from now. They actually show the company almost breaking even in 2023 and 2024. So it's nice to see that analysts are still optimistic about the growth of the company. They still see revenue growing at a very fast rate year over year, which is great to see. And they see this company posting smaller net losses each and every year over the next coming years. A couple different analyst reports that we're going to take a look at now show and kind of recommend whether this company is a buy or hold at its current price point and what they expect for the company moving forward. Our first report is from Morningstar, which gives NIO a 2 stars, which actually represents an overvalued company right now. This company has been young. They've only been in the market for about 2 years, and at its current price point, Morningstar shows that NIO is actually 34% overvalued, and if you're buying today, you're spending a premium of 34% above their estimated fair value, which they put at $10.55. Of course, these are companies where when they're this young and they operate in a market that has a lot of growth potential, fair value metrics may not be as accurate. You're kind of buying this company for the future potential. You're not really buying it for its current value today. You're buying with the expectation that they will continue to grow their deliveries, see double-digit revenue growth year over year, and expand into different markets of the world, one day become profitable and kind of become a global leader in this space. So although they are trading at a 34% premium, you can't really value that like current fair value number too much, because this is the type of company that is operating in a market that has expecting to see rapid double-digit growth moving forward. The next reports kind of just go over exactly what analysts recommend, whether it's buy, hold, or sell. The first one we're going to take a look at, they took an analyst of 12 different people, 1 strong buy, 3 buys, 6 holds, and actually 2 sells. So overall average expectation from analysts is a hold right now. Not recommending a buy, not a sell. If you're already a shareholder in the company, they believe it's a good time to just hold on and ride the waves, but not any strong buy recommendations right now. If you take a look at future revenue growth, analysts are expecting to price target for the company to decline over the next 12 months, but they are expecting revenue to grow over the next coming years as well, following what we first saw from that one estimate already. If we take a look at another report, you can see here that the price target is for NIO at $10.28, which actually represents close to a 27% downside from its current share price right now. And this is once again another hold, only 7 analysts on this report, 2 buys, 3 holds, and 2 sells. So overall whole consensus once again. So for the first two reports, they're already showing price targets in the negative. They already have price targets in the next 12 months for NIO to actually decline, and they're all just recommending hold right now on the stock. If we take a look at a third report to get a final kind of perspective on what analysts are saying, another hold over the past 180 days, this entire report represents a hold. 2 sells, 5 holds, and 2 buys, only 7 analysts once again, and of course, they actually have a much lower price target for NIO at $6.80. That price target has been growing over the past 90 days, but that still represents a 52% downside from where NIO is today. So taking a look at 3 different analyst reports, analysts are not very bullish on the company. Analysts actually expect price to decline over the next 12 months. You can see here it's over the 1 year, it has been a big run up. If we take a look at a more detailed chart over the past 6 months, since the month of June, where the shares were trading around $5, $4 a share, rapid surge, they've more than tripled in price over the past 6 months. And overall, this company has been a huge hype and a lot of surge recently because of their most recent news and headlines. But analysts are not really buying into that right now. Of course, analysts are not always correct. They are predicting the market just like anyone else, and they don't know really anything more than you or I. But these analysts, with using all their different algorithms and all their fundamental techniques to evaluate companies, 3 different reports all put NIO at a hold right now. If you like the company, if you believe in them long term, then you make that buying decision on your own on whether or not this is a company for you. But I just show you what I find from doing my research and my 3 different analyst reports that I always kind of tend to give an overall perspective of the market of analysts, give a hold status on NIO right now. Don't sell out of it if you're holding it. Don't buy into it if you're not an investor just yet. Just hold on, ride the waves, and they will see what happened. The final thing we have to take a look at is their income statement and their balance sheet. Let's just see how this company is performing. They're expecting revenue to grow, how they've grown revenue over the past couple of years. So they just went public in 2018. So over the past 3 years, they have done a nice job of growing revenue. As you can see, over the 2 years of full data we have, revenue has been growing significantly, which is good to see. And over the past 12 months, even during a time of economic slowdown, revenue is higher than the previous 12 months. If we take a look at net income, nothing too crazy here. It's exactly what we expect from a company who's burning through capital, posting huge net losses each and every year. This is a company that is selling shares to generate money, and of course that cash is being used to run the business and grow operations. They're not profitable yet, but the whole hope is that one day in the near future, over the next 2 to 4 years, this company can start becoming profitable, generating mass amounts of net income, bumping up their profit margins per car, and of course becoming a nice, solid, well-rounded electric vehicle company. So overall income statement, not much to go over because of course it's only been 2 years of operations. They're growing revenue like we expect and what we want from a nice young company, but they are posting big net losses, which once again is to be expected, but not always nice to see. Last one we're going to take a look at is the balance sheet. They have total short-term current assets at around $2.1 billion. And one thing we want to take into consideration for young companies like this, a company that was almost going bankrupt months ago, is their current ratio. We want to make sure they can maintain their operations over the short term. As well, we're also going to take a look at their overall ratio to see if they can continue to operate the business over the long term. So total current ratio of $2.1 billion compared to total current liabilities at around $1.85 billion. So current ratio is still above 1. They have the assets on hand to deal with their total current liabilities, but that current ratio is just slightly above 1. Not the greatest. They do want to see that company bump it up or try to reduce their current liabilities in order to kind of maintain strength over the next 12 months. Because if we see another, spike in pandemic cases, or if we see the overall market shut down once again, they may have a tough time dealing with their total current liabilities in the next year. On a long-term perspective, $3.2 billion of total assets overall, compared to $3.2 billion of total liabilities. So an overall ratio slightly above 1. This company's got a lot of liabilities compared to their assets. Negative equity right now in the company. Not great to see, but once again, somewhat normal in this high growth, a lot of hype kind of sector of the market with these electric vehicle companies. So that was a quick analysis over NIO. We took a look at their most recent news headlines. They plan on expanding their battery subscription service, which allows you to pay a monthly fee to get a new battery into your vehicle. They are planning to expand into Europe, which is big news for the company, and they've done a nice job of growing deliveries quarter over quarter and year over year. So this is a company that's been on an insane run-up. They are known to be Tesla's biggest rival because they actually have deliveries and cars being driven on the road. If you're a bull on the EV sector, this may be one you want to take a look at. Of course, analysts, like I said, I just show you what the analysts tell, and they are all recommending a hold right now on the stock. Personally, I will still not be buying NIO. If I am going to enter the EV space, it will be Tesla. I just believe in Elon Musk and the company long term. NIO is not one for me at its current price point just yet. Maybe if we see some growth out of NIO and we see some successful expansion outside of China, then maybe it'll be more attractive to me at that place. But thank you for watching, everyone, and I will see you in tomorrow's video.